oil at $98, markets down, and one rate cut left. That triple threat hits retirees harder than anyone because you're pulling money out of everything and it costs more. Here are the 3 moves that you can make this week.
Welcome to Label on Fire with Amazon best-selling author and Yields for You portfolio manager, LeBel Sternbach. Label on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Label on Fire.
Say hello, everyone, to Mr. LeBel Sternbach. How are you, sir?
I'm doing great. How about yourself?
Unbelievable. $98 a barrel for oil, 7% market drop. So with that regard, how bad is this really for someone already living off their retirement savings just to make a living?
So, that is the $1 million question, right? It's, how will this affect your retirement? And nobody really has a crystal ball, right? And the fact is that we've got lots of people pretending they have a crystal ball, right? And you've got competing agendas, right? Usually if, oil, virtually doubles in price, we would go, well, that's going to have some serious impact on how much things cost, right? Gas is going to go up. Plastics are going to go up. Manufacturing is going to go up. All kinds of things. Shipping costs are going to go up. The same thing with, the Strait of Hormuz being closed, right? 20% of world traffic, world oil goes through there. Ordinarily, you would think that means inflation, right? War means inflation, usually. But again, how things are impacting the economy short-term and long-term is anyone's guess as to what will actually happen. And the question is, how will this happen long-term, right? I mean, the fact is that we've got a president who's monitoring the markets like no president before, and who understands the market in his own very unique perspective. That it just, he saw the price of oil spike, and he was like, well, I'm going to bring it down. And he reduced sanctions, and he released, reserves, and put out incentives. And now people are talking about drilling again, even though these things really don't have a direct impact on the cost of oil. The real question I think that we got to ask ourselves is, what's the long-term impact? Because the price of oil is based on the future price that the market is expecting. That's really what drives the price of oil. But the question is, how long will the things that have happened and that are happening and that will happen in the near future, how long are they going to impact us economically? How long are they going to impact the cost of production and the amount of supply that's available in the system? And there really are no good answers to this, right? Like it's you can look back historically, but historically we've never had a drone war, right? Like we've never had and we've never had 2 wars at the same time that are being fought with long distance cheap weapons. Like it's an insane world we live in.
It really is. We're talking with LeBel Sternbach, and I'm wondering, we're talking to the man who's retired, the lady who's retired. They're pulling $5,000 a month out of their portfolio during this downturn. How much permanent damage does that do compared to someone who's still working?
Well, so this is our bread and butter, right? If you've been listening to our show for any length of time, you know that we've talked about this a lot, right? The fact of the matter is that now with market volatility, right, with the market being down, and I say volatility, and I'm emphasizing that, right, because with the same breath that it goes down, it goes back up again, right, and it goes up, so sometimes significantly more than it went up. But volatility means that we have the risk that we need money to pull out of our retirement. We need money to be able to live off of, and we have to sell assets that are down. And when we sell things that are down, right, let's just use round numbers. If the amount that we need to sell, right, let's say that's a 5% of our portfolio, right, we're living off of each year, or 4%, right, and the market is down 10%. Well, all of a sudden, right, our portfolio is down, that 15% instead of 10%. And that means that recovery, right, it went from needing 11% growth to needing, closer to 20%. That's a big difference. That is a very big difference. And that is where the threat of running out of money in retirement comes from. And so it's really important that we have a plan in place so that where we're taking our income, so that when we have to take our income in retirement, we are not taking it from depressed assets. We're not taking it from things that have a 10% loss in them. We're taking it from things that maybe have a 0.5% or 1% loss in them, or no loss in them at all. And we have a plan in place, because otherwise I can virtually guarantee you will run out of money in retirement. Like, no question about it.
Wow. So my advisor says, and I'm playing the devil's advocate here. My advisor says, stay the course. But when the three things happen at the wrong time, they never happen at a good time when things go bad. And how do you know the difference between being patient and denial?
That's a really great question, right? The difference between being patient and just burying your head in the sand and pretending that, everything's going to be hunky-dory. Mm-hmm. Well, I think that goes to the answer to the last question, right? You need to have a plan. If your plan is just to bury your head in the ground, well, how are you living? Because, listen, if the market doesn't affect you, right, and this money is long-term money, you don't need it to live off of, then yeah, what difference does it make? Bury your head in the ground, because none of this matters to you. But if you're living off of your money, or you need the money in the next few years, it's really important what's happening, right? And you can't bury your head in the ground, because you need to have a plan. You need to be looking at inflation, and, just the way the Fed is, right? The Fed is looking at inflation and they're saying, well, are we adding more jobs to our economy or less? Is inflation out of control, or is it under control, right? And because those directly impact your ability to retire, stay retired. And honestly, right now, we have the dangers of having another, 70s runaway inflation, right? Runaway inflation combined with a depressed economy, that is the worst possibility, right? You have too few dollars chasing too many goods, not enough goods, right? And you have nobody able to get jobs, right? Which also means long-term that our economy isn't recovering. Our tax base isn't growing, which means the federal government's going to have to raise taxes to raise revenue. That's a doomsday scenario. But you got to be thinking about these things if you don't have a plan, right? And you can't bury your head in the sand. So the first thing to do is to make sure that you've got a plan, right? Because if you don't have a plan, then you're on your own, buddy. Right?
Anything can happen when you don't have a plan.
Yeah. Then the government's going to have the plan for you, right? You're going to be living on their dime, and they'll pull it out when you least expect it.
Are we sure we want the government's plan?
I can guarantee you don't want the government's plan. Yeah.
Is this our last chance to lock in at that 4% CD and bond yields before they disappear totally?
So right now we're anticipating, the Fed has communicated that they probably think maybe one rate cut this year. Mm-hmm. Will it actually happen? Who knows, right? I will tell you, in looking at the market, right, the market is acting like there's a potential rate hike, which is weird, right? I mean, we've been talking about going down in rates, and the stock market wants rates to go down, but the bond market is acting like interest rates are going up. And so when you ask the question, is this the last time to lock in rates at, 4%, 4.5%? Well, I don't know where you can get 4.5% on a CD, mm-hmm. But to lock in these high interest rates, I can't tell you for certain. I can tell you all what we know today. I can tell you that the market is pricing in that on, the next 10 years, probably interest rates are going to stay somewhere between 3% and 4%. Will that be the reality? Who knows? What I can tell you is Google's profiting off of this. They've been issuing 100-year bonds, right? Do you think that Google's are going to be around for 100 years? I don't know. But what they do think is that they can get loans they can get people to give them money for 100 years at low interest rates. And they're betting that at some point interest rates are going to go down. They'll be able to pay them back. So when you ask the question, is this your last chance to lock that in? Probably not, but I don't think that you should be basing your investment decisions based on FOMO, right? The fear of missing out on these interest rates, because that is a really bad investment strategy. I think you should have a plan for if interest rates go down, and you should have a plan for if interest rates go up. I will also tell you that a very big part of my job, right, is managing our portfolio at the YFYA ETF. And the entire purpose of that is to find the yield for you when interest rates go down, as interest rates go down. So I don't, locking in a 4% rate is kind of locking in something that's barely keeping pace with inflation. So I don't think that that's really how you should be looking at your portfolio. If you're considering locking in rates, you're probably better off going to the insurance companies, because they'll pay closer to 5% or 5.5%. And there, at least you don't have interest rate risk. You can't profit from it either, but at least there, it's kind of a steady number. It's not going to disappear.
So you're our doctor today, a medical doctor. So I'm going to ask you for a prescription. I need to know, I need 3 scripts, 3 moves that we can make this week to protect our nest egg from all 3 of these things happening at one time: the oil, the drop in the market rate, and rate cuts.
Yeah, so I'm going to get the prescription for this is a little contradictory, right? Because what you're going to do for your short-term money is going to be different than your long-term money. And this is very important, right? Because when you look at a portfolio as a whole, right, and you go, oh, well, I'm going to be 60-40, or I'm going to, whatever, right? When it comes to markets like this, you got to have a plan in place, right? And this is where we're having that income plan and having that investment plan is really important, because for your short-term money, what we're going to do, and you got to make sure you got that bucket that's going to be your spending bucket for the next few years. For your spending money, I'm going to tell you, you want to go on the lower end of that interest rate spectrum. You want to go short term. You want to go money market, high yield savings. If you want to lock in those CDs at 4% for 2 months, I think I saw Chase has one of those, right? Or, other money on the lower risk, go do that, right? Because that's not a bad deal. At the same time, what I'm going to tell you is you've got a lot of volatility in the market. We don't know what the future is going to hold. And so I'm going to tell you on that volatility, you want some way to profit off of it. We don't know what direction things are going to go, but we do know that there's uncertainty. And uncertainty has ways to be profited, right? Covered call strategies are a really great way to do that. And you can get that in, there's various ETFs out there that they manage that. JP Morgan's got some that I really love on, JEPI, JEPQ. But they've got risk, right? Like, this is equity investments, and you're going to profit from the volatility. You're going to profit very nicely from the volatility. So don't put all your money in it. But at the same time, you've got equity exposure. So expect it to go down in value. And then what I'm also going to tell you is when the market goes down, not if the market goes down, when the market goes down, I want you to be prepared to do a few things. Number one is Roth conversions. If you're in the part of your plan involves Roth conversions, absolutely execute them when the market goes down. Number 2, tax loss harvesting. Volatility is great for tax loss harvesting. So you definitely want to be doing that. And then number 3, and I can't stress this enough, when the market goes down, that money you got on the sidelines, or that money that you got a little bit risk off, that's a great buying opportunity, right? Again, you could only do that if you have an income plan and well, if the market's down for 2-3 years, I can wait that out. But market goes down by 20%. Unless something happens and people stop having babies and America really stops being the economic engine of the world, which, if that really is what happens, then you should move to China or wherever you think the economic engine is. But this is who we are, right? So it's going to bounce back at some point. You just need to be able to wait out the market. Yeah,
that makes a lot of sense. And there's more information that you can find, of course, at yields4u.com. That's yields, the number 4, the letter U.com. What did we learn? Well, we learned that we're not going to sell into this dip to cover expenses. We learned that. And that's how a temporary loss becomes permanent. And also we know that you can lock in the yields while you can and make those moves this week. For LeBel Sternbach, I'm Freddie Bell, and this is LeBel on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.